We talked about the enthusiasm for the broader market, the enthusiasm for financials. Does that make you nervous that everyone's on one side of the boat, seemingly?
Listen, there are times where we're all on the same side of the boat because there's actually a really good story there.
Yeah.
And I think that's what financials are. Credit performance, which is the most important thing. Are people actually making payments on their loans? The answer is unequivocally yes. Interest rate with a tendency to rise, Binky was talking about that before, that's a positive. And the loan growth, which has been weak, is something that all indications are that as we progress through 18 and even into 19, that will get better than we're seeing. So the backdrop and the regulatory environment becoming less negative. So it's almost as if everything is lining up for the group to do quite well.
The bear case, Binky, if there is one, and I can make one up on the spot for you just to push back, is the idea that vol stays low, the trading environment's not going to get better for these banks, and the loan demand isn't there for the growth to happen. Is that going to change?
Sure. So, on the financials, I would just add one other thing, which is basically, if you look at the 14-month rally, there's really two sectors that stick out in terms of outperformance. It's technology, of course, but it's also the financials. And I think it's underappreciated that despite the fact that interest rates haven't gone anywhere, that loan growth, hasn't really shown up, earnings growth's running north of 15% as far as the bottom-up consensus is concerned. And the bottom-up consensus, I would argue, in the financials has tended to be quite hesitant. And so, on our metrics, the financials are by far and away the cheapest sector of the S&P. And at the end of the day, relative outperformance is relative valuation and relative earnings growth. So it's a double check mark.
And I want to push back. I just want to push back on something that you said, though.
You can push back on the theoretical bear case as far as, I'm concerned.
Which is, if we were talking about the financials 8-10 years ago, or pre-crisis, these banks really were dependent on their trading operations. These businesses have become, first of all, they're holding much more capital, so they're much more stable. And yes, the trading is less important, so they're not the same as they were.
Jonathan, what's going to be the guide for when the earnings drop on Friday, though? Do you ignore the trading revenue numbers that come out from the previous quarter? Do you try and look forward? Do you look past the murky one-off charges from the tax bill? What's the guide to get through Friday?
Well, I mean, the one thing that I think we're going to try to find out, not only on the banks later this week, but for the earnings season, is exactly what is the impact on your earnings due to these tax changes. And if you want to kind of narrow that, is what is your new effective tax rate? You used to pay 28% or 35% or whatever your number was. What is that now? And we don't know. And banks are probably, a good indicator because they pay a very high tax rate. But I think we're going to see this throughout all of earnings season.